How often have you identified a Stacey Burke signal for the day, then waited patiently for the day to set up and to confirm your entry criteria, and then just went the other way and stopped you out? I'm a Stacey Burke style trader that enhanced his system with his own elements, and I will show you in this video how to trade Stacey Burke signals and how to identify if they are confirmed or invalidated. So stay tuned. So let's look at the core Stacey Burke trading principles first. How is his system built up and what are his key things to look at? So one of his major things is that he says price is always in a box, meaning you have a range to look at and then you check for this range. Is it trading inside this range, ranging, or is it breaking out and continuing, or is it breaking out, turning back in and reversing? Only three things that markets do. Second is other time frame traders driving. So he's emphasizing a lot that you should look at the higher time frames and identify if higher time frame traders driving a move in the direction, and then you need to be careful counter trending that. A couple of signals for that, like out of balance close, he defines it as close in breakout, for example, parabolic channels and some other things. Then major thing, who is trapped. So he's always looking at trapped traders. So the 3-day cycle, for example, is aimed mainly at identifying trapped traders at the high or low of the week. So you wait for a false break, failed breakout on the extremes of the week that close back inside, hits a level on the other side, then there is trapped traders and give you a bias that you trade away from that. And then at day 3, as you know, day 1, day 2, day 2, day 3, you look at a potential reversal or continuation. It's always not clear in which direction this goes, but it's a day to trade for him. Then what he emphasizes a lot is that you have to trade setups. Don't look at movements, try to make sense of every little move and bar on the chart, but identify larger time frame setups especially and trade your setups to be on the right side of the trade and also get the large parabolic moves. Then key thing, timing, levels, behavior of price. So be aware of the clock. Look at your session. Look at first hour, second hour, third hour. What are they doing? What are the levels? Non-negotiable levels on the chart. Previous day high, low, close. Everyone has these levels on his chart. So you get reactions there. That's what it means. And then you look at behavior of price. Is price rejecting these levels? Is it reclaiming the level and making a pullback to continue? Or is it breaking out, coming back in, like with the box, and reversing back down? So always try to identify the pattern of the session and be aware of the overall setups there. And then one of his key things is sit on your hands. So most traders would make a lot more money if they would sit on their hands most of the time. That's what he's saying all over, meaning you really need to have patience and wait for your setups to occur and don't chase anything in the market. So this, in a nutshell, is his trading system. And now let's look at what the flaws of these systems are and why it is so tricky to trade sometimes. So first, maybe looking at the basic patterns. So he mainly talks about pump and dump and pumps. But in the end, this is not really the core of, it is the core of his system, but he looks at more patterns. So for me, there are three major patterns to look at. One, of course, especially for the reversal trades, you have pump and dumps and dump and pumps. But it's not true that he says it's all so easy, keep it simple, and everything is a pump and dump or a dump and pump, because sometimes you get a pump and then a parabolic blow off to the top. So there is not a pump and dump, and this can be very nice trades. So let's look at that. Reversal trades, Market traps traders on one side and moves explosively to take out their stops on the other side. And also profitable traders are on one side after multiple breakouts, and you sometimes wait then because they are weekends in the market. After a couple of breakouts and they are in deep profits, you wait for price to come back and take them out. So the signals for that are first red day, first green day, 3 days longs, 3 days shorts. It mainly means that the market is overextended and has weak hands in the market. For first red day, first green day, is weak hands are because they are underwater overnight, pulled back underwater with the close of the day red, and they are anxious to get out of their positions again. For 3 day long and 3 day shorts, it's 3 consecutive breakouts, and traders are in profits and they are anxious to lose their profits. So in the first sign of weakness, they get out of their positions, and then you get a strong dump. That's the reversal trades. Parabolic trades, meaning parabolic setups build liquidity, trapping traders on both sides of a narrow range. Signal days are inside day, day 0, 3 days into high or low. And then you get a short or a long squeeze. So it's coiling, basically, building liquidity both sides. Inside day is a very nice signal. There you see it best. And then it typically blows off, and you, for an inside day, you wait for a fake out or a breakout on one side, and then you look for range expansion moves. Similar to day 0. Day 0 means peak formation high, peak formation low on the day especially. So it's also trapping traders on the high and on the low, often not as narrow as with an inside day, but also from these trapped patterns you can expect range expansion moves. Typically you trade that from the outside, so meaning you wait for it to break out of that coil, and then you look at behavior of price and look for range expansion moves to follow that move. Then sometimes you have 3 days into a high or in a low, so working a level, and after 3 days you typically can be sure that it doesn't break through anymore, or at least you prefer to trade it the other way, and then you look at the pattern. If you get a parabolic channel, for example, stop hunt, and then you trade away from that and typically get a parabolic move. So that's the parabolic trades. They are definitely not pump and dump or dump and pumps. Sometimes they are on the day, but not necessarily. Often you get a parabolic channel blow off. It's a completely different characteristic than the first ones. Then for me, the third ones are continuation trades. It can be either reversal or parabolic trades, doesn't matter. It just means that the major move has already happened and it's on its way from previous week, sometimes previous day, previous session, and then you come into the session and it's already broken out or down. You prefer to have a day 2 or day 3, 3-day cycle continuation pattern, and you want to have the peak formations in your favor, so seeing trapped traders in the other direction, and then you take the continuation trades. Stacey loved them. He talks about those a lot. He shows them not very often and he explains them not very well, but he says in unsure situations, like on Mondays or in other weird setups, just look at low-hanging fruit continuation trades. Those are the safest ones that give you always a nice trade in a session. Once it's broken down, stays broken down, and then you get a little pullback and you take the continuation. Most people try to counter trend that, and this is exactly why it works so nicely. So let's look at the key issues with his system. So what's the problem once you have such nicely defined, on the first view, nicely defined signals, but then they still often fail because his major elements he's referring to are often not so easy to identify. So what is your box? He's not really telling you that, okay, you have the 100 pip box, major round numbers, but this rarely works from my perspective. And other than that, it's pretty discretionary to identify what is really your relevant box for the moment. So are we already broken out? Are we still inside a box? Sometimes it's just not clear. Other time frame traders driving. So sometimes it's really not clear, is this the case or not? So you have a first red day, you have 3 days of longs. If you try to short that and you get destroyed, he tells you afterwards, oh, of course, this was not reversing. I was aware of that because other time frame traders were driving this move. Thank you. But how to identify really? Okay, sometimes you have a close in breakout, but still, they are trapping then back down? Is it a lower low? Is it a break in structure, or is it a stop hunt? We don't know. Sometimes it's really tricky to see. Then, who is trapped? On what time frame are we looking who is trapped? And how can we determine that someone is really trapped? Or is it just some weird price action? So also there, he sometimes tells you, of course, peak formations and so on, and sometimes it's very clear, but often it's not. Peak formations are pretty discretionary, and many people disagree on what is a peak formation and what is valid and what not. And this is critical and difficult, of course, for the discretionary trading, or if you want to trade it more mechanically, because if many people disagree and you are not clear what you are looking for, then you might do stupid things, as we know. Then, what is my setup? Sometimes it's not clear. Are we in a 3 days of longs continuation setup, or is it a day 0 breakout parabolic continuation trade? Sometimes you don't know until the last moment. If he shows it to you in hindsight, it's clear, of course. Hindsight pays, I'm not sure. But beforehand, very often you just don't know. Because from my perspective, all what he is saying here with signals is not really setups. Because setups really means how is the day setting up. And these signals sometimes are completely irrelevant if the day forms a pattern that does not fit these signals. And that's what the major difficulty with Stacey Burke's discretionary system is, that you really need to judge the price action of the day, the setup of the day, and this has to be aligned with his signal days. He tells you this all the time, but he doesn't help you a lot how to judge this and how to make a final call on your setups and entries. So now let's look at my system edition that really helps to trade his signals and setups successfully. It's called multi-timeframe trading, and it mainly takes one of his major elements, only 3 things that markets do, and mechanically tracks that across different time frames. So here an example on the daily time frame, looking at price is always in a box. So the major box we are looking at is previous day high and low. If we are trading, for example, we're looking also at the other time frames. I will show you that later. But the major time frame first is previous day high and low. He is also mentioning that. And then the multi-time frame structure system tells you how you should think about the bias. So once you are trading inside previous day high and low, this is neutral. So you don't trade from the inside. As he says, if you're not outside, you're inside. So that's neutral. Sometimes you have a parabolic setup from the days before, but let's start from here. So you're first inside, and that's neutral, and that means it stays inside a trading range, and you typically stay away from that. Then another option is it breaks out. Once it breaks out, that means that other time frame traders driving this move out, or at least they are triggered. And once they're triggered, you're waiting for their reactions. What are they doing? Are they pulling it back and then driving it further out? That's a pretty bullish signal. You're then in daily breakout and you get a breakout pullback trend situation. Or it comes back in again, closing back in with 15 minute, 1 hour, whatever you define then as acceptance back in. But once it comes back in, that's bearish, because you're trapping traders at the high, above previous day high, and then you make a breakout pullback reverse. daily fake out high, as I call it, and this is a bearish signal. So this is the basic logic. So always look at the last level that was hit here, previous day high. It breaks out, and then you observe what is it doing. Is it staying outside? That's bullish. Is it coming back in? That's bearish. And if you do this across time frames, then you can see nicely if momentum, how we call it, is driving in one direction, or if it's rolling over and weakness is coming into the chart, and the lower time frames, for example, do fake outs or trapping traders, and then you see it rolling over and the higher time frames follow. So this is a very nice mechanical way, especially if you look at that across time frames, to judge the healthiness and the strength of a trend and to track a potential reversal. So let's now look at how this really helps you to identify a setup and how it relates to Stacey's major elements. So what he says is other time frame traders driving is a major element. So how does multi-time frame help you there? Breakouts show you strength and show you that other time frame traders are driving. So if we are starting here from the left, maybe you have previous month high, it's breaking out, so you are in a monthly breakout, stay broken out, that's bullish on the monthly. Then you might break out on the weekly as well. Then you have a weekly breakout and a monthly breakout staying broken out. That means higher time frames are bullish and driving. And then you watch that further and look on the daily. Are we also in a daily breakout? And then very often you have all those time frames bullishly aligning. That really means you are in a very strong move, pushing price up. And then of course you get the 3-day long signals sometimes, but then you are still careful once everything is green and in breakout. So a 3 days of longs means it's potentially overextended, but as long as you don't get a sign of weakness, you don't short that. So we're coming to that in a minute. Then Stacey's signal, price is always in a box. With the multi-time frame, we have very clearly defined boxes. We look at the monthly box, the weekly box, the daily box, and then also on the lower time frame, 8-hour box. Always the same boxes, and we check, is price strong enough to break out of the box of specific time frames, and we track those breakouts across different time frames. So then fake outs show the trap. Who is trapped? Someone that traded a breakout and then price closed or pulled back inside. So a daily fake out high, for example. So once price breaks out and comes back in, especially for example after 3 days of longs, this is starting to be bearish. Not extremely, because you're still in weekly breakout, monthly breakout, so it might be still only a pullback and then trading further on once it reclaims. But for the moment this is bearish. And then if you track those levels, it might also lose previous week high. Then you have a daily and a weekly fake out. Then it's already much more bearish. So you see, once price action evolves and you track that, you get even more and more signals and information on the strength of a move. And sometimes, of course, it then pulls further down, loses previous month high also, and then you already see it might turn around all the way and you get a bearish trend again. And then the whole thing starts in the other direction. So it's always a wave that extends in the one direction, then it rolls over, and then it gets more and more bearish, then it overextends again, and then it rolls over to the other side. So for the multi-time frame setups, we always look at alignment of time frames. So the best trades are once all these time frames and bias of the different time frames are aligning. So if you are in breakouts, you rather look for continuation trades. Of course, you don't counter trend that. And once you get reversals, maybe in the reversal you might scalp already, but then the reversal continuations, once you have the weekly also in your back, they are much more attractive and profitable typically to trade. But that's the overall logic. And now let's look at specific situations, how this helps you with Stacey Burke's signals. So first category, reversal trades. So let's look at 3 days of longs and first red day. They are characteristically a bit similar, but also different. So 3 days of longs means we break out of previous day high 3 times. So first day breakout, second day breakout, third day breakout, and then we wait what's happening. And the trouble with that, typically with Stacey Burke traders, is that they are once you have the 3 days of long signals, they are trying to short that already and very aggressively. And very often this then still trends further on. So the issue is counter trending parabolic moves and selling the highs just as they are, just as prices selling the high, and then also often early entries. So how does multi-time frame work and help there? So for multi-time frame, we wait this after this breakout, especially for 3 sessions of rise. So we are waiting, we are not shorting before we are maybe at the high of the day, very overextended. So with the 3 sessions of rise on the day, and then we get an 8-hour fake out high. This can be a short on the day to short back to the breakout level. I will show you this in an example. That's the first option, but only if you get an 8-hour fake out high. You don't do that as long as it's further moving up. So you really want to have at least traders trapped on the day over above an 8-hour fake out level. Or even better, wait until it loses the previous day high. So once it trades down through previous day high, you get a daily fake out high, and then you might have already an 8-hour fake out high or an 8-hour breakdown for a low-hanging fruit trade. But once it loses this daily level, then you already have the 8-hour and the daily bias in your back, and this helps you to see that it's really showing weakness and trapping traders at the high. So you wouldn't trade into previous day high. That's just too risky because it might just pull back to do a continuation trade. So once you get a smaller time frame fake out above previous day high, that's a clear sign for a continuation trade. You wouldn't short that. And this is what multi-time frame logic helps you in this case to look at. So really 8-hour and daily fake outs as key confirmations. And then also you look, of course, on the higher time frames. Weekly, is the weekly in breakdown, and this is only a pullback, low-hanging fruit continuation on the higher time frames, or is the week also in a fake out high and we are reversing down from a major resistance level, for example? Then you also get more bias in your favor. Then looking at first red day, this is probably one of the most difficult to trade because it very often fails, but also multi-time frame logic helps you with this signal. So what's the logic? First red day means you have a strong pump, then a peak formation high, pulling back down, closing red. That's more or less the basic definition. And then is very often what happens the next day is that you get a fake out high, so it breaks previous day low, and then it just trades on and kills everyone that tries to short that. Because sometimes it's, if you get a fake out low, it just traps the shorts. Many people are trying to short it. These shorts are often becoming trapped, and it just blows to the top and continues on. So how does multi-time frame help you with that again? So a first red day typically breaks out after longer uptrend situations and then pulls back inside. So that means that's already often fake out high. So if you get a first red day that closes in breakout red, this is of course no signal that would help you. So you often or sometimes you get the first red day that's still in breakout, so this is already showing you that it's not a strong signal. and once it's closing in fake out, then you're watching the fake out level very closely, and often it trades up again. And as long as you're trading above this fake out level, because then it's bullish again, you wouldn't short that, because this then is rather a signal that it's trending on. So you wait for price to lose this daily level again, making this previous level a fake out high. And then from there you can be pretty sure that it's reversing, but only if it didn't hit the previous day low first. So this is only valid as long as you're trading inside here and then losing this level again, then you can be clear that this is a reversal here. So also here the 8-hour and the daily fake out levels are the key levels in the sand to look at. I will show you this on the charts later on. And then also daily fake out low as a counter signal, and then also weekly bias as confluence. So the weekly, if the weekly is in breakdown, same logic, then you might be in a low-hanging fruit situation on the weekly template, or in a fake out high, then the bias is also in your favor and you prefer the shorts. So that's the reversal trades. Major level is previous day high. You really want to roll over with this level. This is the major signal to have a death line set up to confirm for you that these traders above these levels are trapped. Then you wait for timing levels behavior of price later on, lower time frame fake outs, and then you take the continuations back down. That's reversals. Then parabolics. Parabolics can happen in two major situations. One is inside day, so coils, that's coiled sideways, maybe into a level or just sideways. And then from there you look for range expansion moves. This is more or less the classic multi-time frame trading setup because it aligns perfectly with the logic of multi-time frame. So what's the common issue with that? Often it breaks out and people trying to take the breakout trade, and then it just reverses. And as you know, we trade inside days from the outside, and we looking either for range expansion or a reversal to the other side, because the stops of the breakout bar traders are on the other side, and often you just don't know for quite some time what might happen. Either fake out reversal or breakout retest continuation. But also what's the issues that you get it wrong. But if you watch the breakout and fake out levels and the bias together with the 8-hour level, then you have the same logic. You really want price to trade back in, confirming this a fake out, and also then you're looking at the lower time frames. 8-hour, is it also in fake out? Then you could be pretty sure that this is reversing down. But if it's breaking out, pulling back, and maybe you get a lower time frame fake out here, fake out high in this case, trading outside the previous day's level, then you can be pretty sure that this is a continuation trade. But that's more or less the basic logic of multi-time frame. Then day 0, day 3 trend. So a day 3 3-day cycle. If this is a day 1 at the low of the week, for example, peak formation high, peak formation low, day 2, and then you get a day 3 blow off. What's the issue with that? Sometimes also people try to take the reversal on day 3, because Stacey always says Wednesday, day 3, parabolic reversal, very nice trade. And on the other hand, often people are anxious to buy the high here if you're in a parabolic situation, and they just miss the parabolic longs, because the parabolic longs are pretty tricky signal wise, because Stacey Burke's signals don't really show you a way into these trades. He's rather a reversal trader, and all his signals rather point to reversal situations, not so much to continuation situations. But also here, if you look at the daily levels and the 8 hours, then this shows you the way. So once you're in breakout here, it trades back inside, that's bearish. It trades back up, that's bullish. So On a day 3, then you watch how are you trading in relation to this last daily breakout level that was hit. And once you're above that, you're definitely not short. And if you get a nice pattern with a lower time frame, fake out low or breakout, then you might already take the long from the inside as a parabolic continuation. The safer option, often depending on the template, is the breakout trade, that you wait for it to break out of the previous day high, wait for another fake out low, and then take the continuation. So also here, always look at the daily levels, never short once you're above, only if you're very far up, and rather look for longs as when you're in this situation. And then also, again, for both these situations, the weekly bias. So the weekly here for the inside day is very important. You have the daily bias from the day before and the weekly bias helping you with the direction. And also for these trend trades, if you are in a broken down market, then you would not take an aggressive continuation trade here, for example. This is rather something for a situation where you are in a weekly fake out low. So you have the weekly bias in your back, or in a weekly breakout that you're in a strong uptrend and you just look for the continuation of this move. So that's the second category. And now let's look at the third category, continuations. These are the best situations for the multi-time frame logic, I would say, because here many people are struggling to trade those because it feels very bad at the moment to take those continuation trades. So let's look at it. Low-hanging fruit, for example. So you might have a first red day, 3 days of long. It already in London reversed and pulled back heavily, and now it's breaking down and you are maybe at previous day low or even below that. And then you might think, okay, that's too deep. I can't sell the low. And I think it might rather go up again, and you buy the low. And then you're just counter trending a broken down market. You have fear of selling low, and then you just buy the low, and then it just falls through. What you see all the time, people trying to long that. So what does it do? It just falls further down and kills all of those. How does multi-time frame help you? It's the same logic. You look at previous day low. Once you're trading below previous day low, then you already have a pretty bearish multi-time frame situation. Daily breakdown, maybe also weekly breakdown. Then you look at the 8 hour. Do you get an 8 hour fake out, or are you in an 8 hour breakdown? And then you just see that the market is heavy and bearish, and you never short that once this is all red and you're trading below the daily breakdown level, and you just look for a lower time confirmation, or in some parabolic situations you just sell it if timing is right, and take the continuation leg down. I'm doing this all the time. So here 8 hour daily levels at key determinations for the bias, and the weekly also as confluence. Then breakout continuation, more or less the same logic to the other side. So here it's also, as we've seen before with the parabolics, the continuation trade is the breakout trade. So that's the low-hanging fruit on the upside. And there also many people try to short that, selling the high and are anxious to buy the high. So many miss these trades or get even destroyed by shorting it. How can you determine that this is a continuation trade? Same logic. You look at the daily breakout here, daily breakout there. You look at the weekly breakout. So are we in a parabolic up move or coming out of a fake out low? Or are we in a broken down market? Then we are careful. And once timing levels behavior of price confirms here and bias is in your favor, then you just wait for a lower time frame confirmation, and as long as you are outside previous day high, then this can be a very nice setup, and you just take the continuation. And this is trades that happen almost every day and give you a very nice win rate and risk reward situation. So that's the overview, and now I would like to look with you on the charts and give you some specific examples of that. So now let's look at the chart. First, typical day 3 longs, first red day fail situation. So what do we have here? It's a 3 days of long. Here a first red day that pulled further up. Now peak formation high, pulling back down again. What from a multi-time frame perspective already prevents you from shorting is that the 8 hour, you see it here, is in breakout. So you don't have an 8 hour fake out high. The last 8 hour level is down here. So you are still in an 8 hour breakout situation here. That's not good. And also the week and the month are in breakout, and you're trading at the low of the range coming into third hour here. So that's to take here the continuation into these levels with a missing 8 hour fake out high with the higher time frames bullish doesn't look very good. And then you see what happened. It even made an 8 hour fake out low into third hour. That's something I also never trade into. If you have a fresh fake out low on the 8 hour coming into third hour, then all day 3 longs and first red day signals don't help you anymore. You have a 8 hour fake out low, counter signals, the higher time frames are bullish, even if it's overextended, and then you just don't take any shorts here, and you see they wouldn't have worked out. It just goes long or more or less grinds around. So that's a classic first red day fail, 3 days of longs that you shouldn't short. I mean, you could have taken it here early in the session, but this is pretty risky. You don't know how far this comes back down, because here is the daily breakout level, so it might also reverse already there. To take it here with New York Open, also risky, maybe from there, but it's pretty narrow and just wouldn't have given you a nice trade. Then a reversal trade, how you want to see it. So that's a day 3 longs, 3 sessions of rise in breakout situation. So that's previous day high, it breaks out. 1 session, 2 sessions, 3 sessions. That's the 8 hour fake out high into third hour. That's a very nice pattern. The daily breakout level is down here. So it is bullish across all time frames, but it's very overextended, and you get an 8 hour fake out high with very nice timing into the end of the session. And then you might take that trade. You see it here. It also does a lower time frame fake out high, and then it just collapses after the 8 hour fake out high from the high of the day into third hour. Target is the breakout level. That's already far enough, and then from the breakout level it goes sideways again. So this is a reversal trade that was confirmed by the 8 hour fake out level, and then even that it's counter trend on the higher time frame, it gave you a very nice result and was confirmed with multi-time frame. Then let's look at another situation. That's a breakout continuation situation, so a parabolic trade, the second category. We have here all time frames bullish. We are in an inside day situation. So coming out of an inside day, it's broken out. It didn't do an 8 hour fake out high, but pulling back into third hour. So without an 8 hour fake out high, you are careful, because the 8 hour is still in breakout. Inside day breakouts you don't want to short anyways. So you wait what is happening. It's pulling back. Still all time frames bullish, and then you get a lower time frame fake out low, and then it's clear it's just a continuation trade. All time frames bullish, inside day continuation, lower time frame fake out low, and then you just trade the long and don't join everyone that tried to short the high and gets trapped and killed here, but you're just following the trend and trading the parabolic situation to the long side. That's parabolic. And then let's look at continuation. That's a reversal continuation situation. I love those a lot. Most people always try to short the high. Here you see nicely that this is not necessary. So after 3 days of longs, here you see that London was trapped at the high, printing a deathline setup, daily fake out high into New York session, New York pulling down, breaking down the 8-hour level. So here you have an 8-hour breakdown, smaller time frame fake out high. So once you're trading 8-hour breakdown, and then also at the low of the day, trading below the low of the day, then you are willing to take the continuation trade here with a smaller time frame fake out high, and then you just follow the reversal trend. It was also here higher time frames bullish, but the lower time frames 8-hour daily, very nice template and nicely aligning. Then you just wait for behavior of price into 3rd hour, and then you see in this case it just fell through, never reclaimed the 8-hour lower time frame fake out high, trading below the low of the day. Then you just take the continuation. Most people try to long that again, trying to buy the low. You don't do that. You trade with the trend and kill everyone that's counter trending, and then you just take the range expansion to the low and have a very nice trade. So that's the logic, how multi-time frame helps you to have a mechanical overlay of the Stacey Burke signals. This was part 1. This was more for signals and higher time frame setups. I will make another video on setups on the day, 3 session setups, and highlighting more everything around the 8-hour, 4-hour and lower time frames. And then I also will do a video on the entries, because multi-time frame also helps you a lot on the entries with the 15-minute and 5-minute fake outs with the right timing. You get very nice continuation trades. So if you like this type of thinking around trading, I'm happy to answer all your questions in the comments below, or you might also want to join my Discord where we can discuss that. There's a lot of material around this logic. I would be very happy to welcome you there. Otherwise, thank you very much for watching and for your patience, and have a nice day.